Here's a kind of possibly controversial idea. Do you think that FedWatch or the dot plot becomes more reliable or less reliable depending on whether it coheres with the other one or it doesn't?
When central banks think ahead, they are mostly relying on how the economy will be doing in the future rather than the current situation.
If we bring up the chart of gold, do you think that that's primarily a reflection of the declining dovishness?
Gold gets affected whenever we have shifts in monetary policy, especially unexpected ones. The issue is what happens if the two major tools that we have agree, but then we see a complete different image.
And one of the main tools within forward guidance, one of the reasons I say it's meant to move markets, is the Fed's dot plot. How do we read this? How do we interpret it? Or how do you personally read it and how do you interpret it? Hello and welcome back to Trading Talks. In this episode, which is the first of 5 about central banks and monetary policy, we're going to be looking at central banks' forward guidance, and specifically we're going to be discussing what forward guidance is, how it compares with various other tools that traders have to try to guess what central banks are going to do next, looking at some examples focusing specifically on the Fed, analysing what happens when expectations and when forward guidance shifts, and we're also going to be looking at some relevant charts, primarily gold and euro dollar. And I would just remind you, if you haven't done so already, please subscribe to this channel and have notifications turned on so that you're always aware immediately as soon as a new podcast is released. I'm Michael Stark, Financial Content Leader, and joining us as guest here on this podcast is Antreas Themistocleous, Trading Content Specialist.
Hello, Michael, and thanks for having me.
That's fine. Thanks for coming on, Antreas. And I think the big question of why central banks forward guidance move markets, this obvious answer to that is that it's meant to. But let's start from the beginning, I suppose, and break it down. When you hear forward guidance, what are some of the main things that you think about? Introduce.
So it's when central banks think ahead, let's say, because they are mostly relying on how the economy will be doing in the future rather than the current situation. For example, future GDP or inflation data or labor market data, that is, and so on. And part of it is because any action that the central bank will take needs time to, have an effect on the market. So it does not make really sense to rely on current data.
Yeah, that makes sense.
I mean, current inflation data, current GDP, how the economy is doing, labor market and all that.
Okay. And one of the main tools within forward guidance, one of the reasons I say it's meant to move markets, is the Fed's dot plot.
Yeah.
So let's, I think, look at an example of the Fed's dot plot from March of 2025, which is one of the fairly recent ones. And so the dot plot, from what I understand anyway, they started doing it in about 2012, primarily to temper expectations, to give markets, some expectations of this is where we're going, so that people don't suddenly panic when they hike rates or when they possibly signal a cycle of doing something or doing something else. So let's look at the dot plot. How do we read this? How do we interpret it? Or how do you personally read it and how do you interpret it?
Okay, so first of all, the dot plot shows each Fed members' projection for rates in the coming years. It's not a forecast. It's more of a current thinking. Like with the data that we have now, what are the projections of the Fed members? Now, if we take a look at the Fed dot plot, we see that the majority of the dots is for 2026 is around 3.25%.
Right.
So that's quite lower than the current levels, which are 4.25. It's almost a whole percent lower.
Yes.
So that's a more dovish projection, if you wish. Just to make clear, because we are going to be mentioning it a lot, dovish is when we expect the central banks to cut rates, and hawkish is when we expect it to hike, to increase. So quite a dovish image on the dot plot for now. As data come in, as new inflation data come in, we expect to see changes. But for now, it's expected around 3.25 for 2026. That is.
Okay. And one of the things that we contrast this very often with is CME FedWatch, which is a tool offered by CME to watch what the Fed is going to do. It is based basically on data from futures and swaps, as far as I understand. It's based on real data from real traders, and that's something that works in concert with the dot plot. You think?
Yes, it uses the Fed funds future pricing,
right? Yeah,
to come up with probabilities of rate hikes or cuts or hold. Early in 2025, the probabilities on the FedWatch tool was for 3 or 4 cuts throughout 2025, right? Now that image has shifted and currently it's for just 2 cuts. One is expected in September's meeting. If we take a look at the probabilities, it's currently 55%. The first cut to be in September, and then for the December's meeting, another cut around 41%. 41% is not that high because especially it's for September, which is in 6 months period, a lot can change. But currently the image is that there's first cut in September and another cut in December's meeting.
Yeah, but equally I think something that's important to think about with this is it has a lot more dimensions than the dot plot does. And what I mean by that is we can look several months in the future, and if we look at, for example, December's meeting, well, the percentages here, they also very much depend on what happens in the previous meetings. Because if, let's say, we get all the way to October with no cut, which is unlikely, but if that does happen, then certainly I don't think anybody's going to be expecting a triple cut in December's meeting. That's not going to happen. So it depends to a great extent what happens in previous ones. Okay, and here's a kind of not super controversial, but possibly controversial idea. Do you think that FedWatch or the dot plot becomes more reliable or less reliable depending on whether it coheres with the other one or it doesn't? What I mean by that is, let's say if we look at the end of this year, we've got around 41% chance of 3.75 to 4%, according to CME FedWatch, right? And that aligns almost exactly with the dot plot. I mean, with the majority of the dots I'm talking about on the dot plot for the end of the year. Do you think that makes that more reliable?
Yeah, I do believe that as many tools that combine and give the same image, I think that probabilities get more reinforced, if you wish. Now, the issue is what happens if the 2 major tools that we have agree, but then we see a complete different image coming up. For example, if inflation in the States rises rather aggressively, right, then I think we will have a quick shift on those probabilities quite fast.
Yeah.
So yes, the probabilities for now is to have at least 2 cuts, but if inflation shifts, then also the probabilities will shift. And inflation is the main job, if you like, for the Fed. I mean, control inflation, right? So if we see a spike in inflation, I don't think that we will have 2 cuts or any cuts.
Yeah.
But that's just a hypothetical scenario. But the main idea is that when the 2 tools agree, it's more likely to happen, right?
And I think the key point here also is this example that you cite about inflation going up. FedWatch is going to react a lot more quickly than dot plot, because the dot plot only comes out 4 times every year at the end of the quarter usually, whereas FedWatch, it might be updated just a few minutes later. People can react often quite quickly to that. Yeah. So, and I would stress at this stage, we've talked a little bit about the forward guidance and methods of forward guidance, including the dot plot. You want to go into more detail about that with more specific examples, click on the link in the description to visit the article on Exness Insights. You can find out a lot more about that. So let's look at some examples, right? If we bring up the chart of gold, I think that's probably the main relevant example. Generally, it has been pretty strong for the whole year. Do you think that that's primarily a reflection of the declining dovishness or declining dovish expectations, at least for the Fed?
Yeah, sure. The gold gets affected whenever we have shifts in monetary policy, especially unexpected ones, because, when something happens, for example, a hike happens when the market was not anticipating it, we have a lot of fear and exaggerations by the traders. And the first instrument they run off to is gold, right? So it's affected to a great extent, more than others, I would say, gold. So currently we see a slight correction on the chart, on the daily chart of gold. Whether that will hold, time will tell. Because for now, the expectations for the Fed interest rates is that they will hold for now until the September meeting. So I don't expect any major shifts on gold that rely on interest rates. Maybe some other factors might affect the price of gold, but as it comes to monetary policy, I don't expect any major shifts. Until September, at least.
Unless there's a surprise,
Yes.
and that's what we're going to be talking about in the next podcast. Thanks very much, Andreas, for
Thank you very
joining us
much.
here.
Thank you very much.
And thank you also to our viewers. And so the next podcast is going to, in the series, is going to be about surprise changes to rates. I would just remind you, if you haven't done so already, please subscribe, turn on notifications so that you can be aware immediately of when the next episode is coming out, and hopefully see you there.